FORA.tv. The world is thinking.
So once the economy starts to grow, it will be very difficult for the Federal Reserve to pull out all that monetary stimulus at a very quick pace and not hurt the economy at that time. The Fed's job in that endeavor will be made a lot more difficult by the huge federal government deficits that we're going to be running this year, next year, and the following year. Last year we had a 3% federal deficit. This year it's projected at 12%, and next year and the year following, so roughly at 9, then 8% in that magnitude. Those are very large deficits. A lot of stimulus, like I said, will be coming online 1 or 2 years from now. And at the same time, the Fed will have to pull back at that moment. So what you can expect there is an enormous fight between the Federal Reserve, the administration, and Congress, probably. Congress has to run for office next year. The president wants to have his long-term changes in place. More education, health care for all, more environmental regulation, more spending on research, and so on. All those are long-term projects. They will hit the economy 2-3 years from now, just as all that monetary stimulus that the Fed had been pumping in starting last year will also still be very effective. Now, can you see a Federal Reserve chairman who will be really stepping on the brakes while the government is going full steam ahead? You know one person like that, and that was Chairman Volcker back in the early 80s. He stepped on the brakes not once, but twice. The prime rate was at 20%, in case you forgot. And the economy was thrown twice into a recession, back to back. But he had the full support of President Reagan at that time. Well, Reagan had not appointed Volcker. That was Carter who did that. But he had the full support of Reagan. And Reagan said, we want to get inflation under control. Okay, you tell me whether the chairman of the Federal Reserve, whoever that may be, and Bernanke's job is up January 1st of next year. His term is up as chairman, not as a governor. But his term is up, and if he, first question is, will he be reappointed? Right. Second, if not, he will be replaced by whom? And will that person, appointed by the current president, have the fortitude to really tighten the monetary conditions again when it needs to be done, unless you want to have high inflation, which will wipe out your savings again, especially if you've been running into long-term treasury bonds for safety. That will be the next thing that will be hit as interest rates spike. So beware of that coming bubble.